All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be talking about the impact of trade deficit on foreign exchange rates as well as interest rates. Okay, so we've been talking about trade deficit for a while. We know that trade deficit is when imports are more than exports. Okay, and trade balance is when imports equal exports. Okay, however, when you do have a trade deficit, your trade deficit is directly proportional, okay, to a reduction of domestic exchange rate and an increase of foreign exchange rate. Now, suppose you have your aggregate supply over here and your aggregate demand over here. Okay, what's going to end up happening is, okay, suppose this is your foreign exchange rate. Okay, what's going to end up happening is your demand curve. Let's assume that this is your aggregate demand. This demand curve will move to the right. Okay, so say for example, over here somewhere. However, we won't draw the demand curve yet because your supply curve will move to the left. Okay, just as your demand curve moves to the right, your aggregate supply curve moves to the left. Okay, because your supply of money, supply of dollar, for example, goes down. Okay, so say for example, this is your aggregate supply one, AS1, and this one over here, this will be your new equilibrium. Okay, and we know that this part over here, this is your aggregate supply. This is your equilibrium, which basically means that okay, as the demand shifts to the right, your supply shifts to the left. The reason for this is because when you have a recession, for example, okay, let's say you have a recession. When you have a recession, what's going to end up happening is the GDP will go down. And as GDP goes down and unemployment goes up, the production goes down. Production goes down. As production goes down, okay, the domestic currency falls. So the value of domestic currency falls. So value of domestic currency falls, leading to a recession. This is domestic currency. This value falls, okay, leading to a recession. Now, because of this value, okay, what's going to end up happening is the demand for domestic currency goes up in the foreign markets. Okay, so demand for domestic currency goes up. Domestic DC currency goes up in the foreign markets, so overseas. All right, because obviously when you see a weak dollar, for example, people would want to invest more, right? People want to buy for less and sell for more to make a profit. All right, so when they buy a dollar for less and they sell that same dollar when the dollar climbs up in value, or if they buy a good or a service for a lot less when the dollar goes down, and they let's say they sell the same good, the same product in their home country for a lot more, they make profit. All right, so imports go up, okay, for foreign countries, okay, which basically means that exports go up for domestic, okay, countries. So exports go up for the home country. Exports go up for the home country, okay, for the home soil. And apart from that, we also know that the foreign exchange rate goes up. So the foreign currency goes up in value with reference to the dollar. So with reference to a dollar, the foreign currency is much stronger. So foreign currency goes up in value. And as foreign currency goes up in value, okay, remember, because of the recession, okay, the currency over here, the domestic currency went down, as a result of which the demand went up. Okay, and because the foreign currency goes up in value, apart from raising the demand, it also reduces the supply of the dollar. Okay, so supply of dollar, because output goes down in a recession, which means production goes down and supply of the dollar in general goes down. Okay, so supply of money on home soil goes down. So supply of dollar goes down. So supply of dollar goes down. And because the supply of dollar goes down at the same time or simultaneously as the aggregate demand goes up, okay, what's going to end up happening is the foreign exchange rates will climb. Okay, which basically means that if this is euro, okay, your euro per dollar will be much higher. Okay, it will be stronger. Okay, let's assume that over here your euro is 0.8, something of that sort. And over here, euro is 1.2 per US dollar. Okay, or per Canadian dollar, whichever one of those two. So euro per dollar. And you can take any other currency in the same manner, okay, as long as it's a foreign currency. So the foreign currency is much stronger than the domestic currency. All right, that's basically what this graph tells us. The foreign currency is much stronger than the domestic currency. Now, as the foreign currency gets much stronger than the domestic currency, okay, the interest rates on home soil goes up as well. Okay, because we know, okay, during a recession, okay, the recession is caused by interest rates going up, for example. Okay, when it comes to a monetary or fiscal policy. So monetary policy, we know that the interest rates go up, as a result of which the GDP is contracted, the GDP goes down, and because the interest rates go up, okay, the domestic consumers, so private consumption goes down, okay, but foreign consumption goes up. So exports go up, so foreign consumption goes up, and foreign capital investment goes up. So foreign capital investment. So foreign investment goes up. Okay, why? Because they want to take advantage of this high interest rate. Okay, if your interest rate is high, you know that you're going to make more money from your savings account in the bank. Okay, if your interest rate is high, you know that you have a larger return on investment, as a result of which foreign investment goes up. As foreign investment goes up, okay, your foreign exchange rate goes up, which means it becomes more stronger. All right, and foreign exchange rate becomes more stronger. All right, it will lead to further exports. So exports go up for the home country. All right, and this is considering ceteris paribus, considering all other factors are equal, such as private investment, okay, your budget deficit, so on and so forth. Okay, so apart from that, this is Obey on behalf of V Electronics. This is Obey. Have yourself a great day.